Hello everyone, welcome back. This is part 3 of investing in ELSS/mutual funds. We are going to discuss 5 methods to understand market movements. If the market is trying to move up, where it can take resistance, and if the market is falling aggressively, where it can take support, and how to identify important support levels for lump sum investing by analyzing charts and patterns in TradingView website. If you missed to invest during the COVID crash because you couldn't find the bottom, then this video is for you. I'll show you the exact place where Nifty took support during the fall. You can also verify this for Nasdaq and S&P 500. For those who are new to this channel, in part 1 we discussed the selection of mutual funds for short term and long term, where we check the probability of a fund to generate 15 or 20% CAGR returns if you started investing in it from today onwards by analyzing the past performance. In part 2, we discuss the actual returns of the mutual fund investing by considering all the deductions and how the compounding effect of inflation can never make you rich. We discussed this in detail using a spreadsheet and formulated a plan to overcome the dire effects of inflation, and here we are to implement the strategy with the help of TradingView platform. I'll also introduce to 2 more websites to help you analyze if the market is overvalued or undervalued at this situation. By the end of this video, you'll have 90% more knowledge than the other retail investors. It is very easy to set up the charts and have a quick understanding of the present market conditions. You can easily do this with your mobile. All the methods discussed in this video can be accessed for free, and you do not need to subscribe to a specific plan in the TradingView platform.
What you see here is the TradingView website. To get started, first we need to sign in. You can click on this icon and sign in using your Google account. And to open the charts, we can click on any of these icons. The first thing to do before we get started is to head to the bottom right of the page and click on the nut shaped icon and make sure the auto option is ticked. Since we are analyzing for long-term investment, we will either go with the weekly or monthly time chart. Our intention is to identify the market dips, and whenever the market is falling by certain percentage, we are trying to invest a lump sum amount. We discussed 2 methods in the previous video. The one is either you'll be having a SIP running throughout your entire duration and adding a multiple of SIP as lump sum whenever the market is falling. The other method is to also actively invest the SIP amount along with the active lump sum option. We can start typing Nifty 50 to enter the Nifty 50 chart. Okay, in total we will discuss 5 methods, and in the first 3 methods we will understand to find the market trend if it is moving in the upside or downside, and in the last 2 methods we will identify the exact bottom location where the market is trying to take support and bounce back. The first method, DMA moving average. You can click on this icon indicators and type 50 200 moving average. You can see 2 lines appearing in our chart. The green line represents the 50-day moving average and the red line represents the 200-day moving average. These are the basic support and resistance line based on the market movement. Here we can see in many instances where Nifty has taken support near the 50 DMA line and also the 200 DMA line. So you could consider to invest a lump sum whenever the market either touches the 50-day moving average or 200-day moving average. But we have some exceptions here. Sometimes the Nifty crosses the 50 and 200-day moving average and taking support at a random position. In the later part of the video, we'll understand these are not random positions and we can identify these exact locations. So the next indicator is super trend. We can again go to indicators icon and type super trend. We can see 2 sets of lines appearing. The red line showing the bearish indication of the market and the green line showing the bullish indication of the market. So this is a lagging indicator for the reason because we can see here Nifty has increased from the depths of almost 8,000 and has continued in uptrend for almost a long time, and we can see that it breaks this uptrend only in this candle, and from that we can see there is some consolidation for almost 2 months. Nifty has started falling from almost this zone, but the trend is proven only after this candle. We can verify this in the monthly chart as well. So this is the COVID crash and we can see Nifty has formed a big red candle, and only in this green candle we can get a clear sign indication that the market is moving up, and from there we can see it is always green till today. So if you wanted to invest a lump sum amount during the bullish zone, consider to invest near to this super trend line. And when it is trading away from the super trend line, we can continue with our regular SIP option. Also, you could consider investing a lump sum amount whenever red zone appears, but it is not a clear sign indication whether how much the market will fall from here. So the next indicator is by drawing the trend line for the Nifty, for which we will remove these two options. You can go to the left side of this section and click on the top icon and click on ray option. Just for the sake of drawing the trend line, we will go to the daily chart. Can you spot the trend line here? Okay, it's a bit difficult, but we will identify using these lines. Likewise, we can draw a trend line for the bottom part as well. I am able to spot one more trend line here. So we can see that Nifty is broadly trading in these two trend line regions, where there is a upper portion of the trend line and there is a bottom portion of the trend line. We are presently in a bull run and we can see the Nifty is trading in the upper part of the trend line and it is taking a support whenever it touches the middle trend line. So whenever you feel the market is bullish, you can wait for the market to correct and fall to the bottom part of the trend line for investing a lump sum amount. If you feel the market is more bullish, you can consider to add a lump sum here or your regular SIP here, but do not add any amount during these regions. We can see clearly the market is taking a resistance at this upper part of the trend line and it is taking support at the bottom part of the trend line. We will get back to our monthly or weekly time chart and we can see that the channel appears more clear. So there are two things the market can do in the immediate next week. Either it could break the middle part of the trend line and trade in the bottom part of the trend line, or it could bounce back from here and continue to trade in the upper part of the trend line. Okay, let's continue with the fourth method, for which we will delete all these trend lines. You can go to the indicators icon and type relative strength index. Now you can see a set of new graph appearing here. We need to do certain changes in the settings before we can start analyzing this chart. We can go near to this RSI heading and click on the settings option. There are two things to be changed. You can go to the inputs tab and change the RSI length as 2, and in the style option we will change the RSI upper band to 90 and lower band to 10, and also we will change our chart to monthly time frame. So this is a very powerful indicator and it can help us identify the bottom zones in a bearish region. So the main strategy is that we will invest a lump sum amount whenever the RSI value is falling below 10 and above 100 represents a bullish zone. It indicates that there is a downside potential from here, and whenever the market is falling below the RSI value of 10, it indicates that there can be a potential upside from here. We can verify this during the 2008 mortgage crisis. Here we can see almost in all these candles RSI has closed at a value of 14 and here it has closed at the value of 12, but during this region, that is during the exact bottom of this trading zone, the RSI value has closed around 3.5 and we can confirm this during the all downtrends and also during the COVID crash as well, where we can see a large red candle and below that we can see the RSI value to be 2.47. So this is where we will invest a lump sum amount. So by checking the RSI option, we can here identify the bottom part of the bearish zone. The final method to identify the market dip is by using the Fibonacci retracement. Again, by using the icon in the left side of the trading window, you can click on this option and click on Fib retracement. Now the Fib tool is active. For using this indicator, we need to spot the changing trend lines. We can see the market has fallen from a high of almost 6,000 to 2,400. After this fall, there is a higher highs and higher lows being formed till this zone. So the main idea is to draw a Fibonacci retracement from this changing point high to the bottom point low, where the market has changed its trend from making lower lows and lower highs to start making higher lows and higher highs till the point where it made higher highs and higher lows. So we will select these two top and bottom points to analyze the Fibonacci retracement. What we can see here is that Nifty has remarkably closed at the 50% of the retracement value. So this is a very powerful tool if it is used in a correct way. We can also verify this for S&P 500. In a similar way, when we connect the bottom portion of the downtrend and the top portion of the uptrend, we can find the retracement value where the S&P 500 has retraced to 61.8% before continuing its uptrend. So this is a very powerful tool, like how it is respected in the universe. For example, in the shape of the Milky Way galaxy to a shell found in sand beach or the flowers of a petal, it is also respected in the stock market. It is very strange, but it is true. It is very exciting and fascinating at the same time. Okay, the bonus point to check if the market is overvalued or undervalued is by using the screener website and checking on the Nifty 50 chart. By clicking Nifty and clicking on Nifty 50, we can see the chart appearing in the screener window. If we scroll down and select the maximum option here and select the PE ratio, we can see that Nifty is mostly trading with a median PE of 21.8. If the present value is higher than 21.8, it is slightly overvalued, and if it is much higher than the median value, it is time to be cautious. And when the Nifty is trading below this number, it is considered to be a good buying zone. It is considered to be a good accumulating zone. When we check the recent PE values, it is almost close to the median PE of 21.8. So we can expect Nifty to reach values of 25 and 27 before seeing a small correction in the market.
Use these indicators with market mood to get a feel of where the market can move in the short term to plan your lump sum investments. Markets in the short term are driven by sentiments, and it is due to this reason they are very volatile in nature. But it is the economic outlook of a country that decides the broader market movement in the long term. And I believe India's growth journey has just started, and in the next 10 to 15 years, we can expect Nifty to be trading at the levels of 1 lakh. Make sure to subscribe to stay updated with the economic trends and learn more about wealth creation by identifying the next mega trends in our economy, and also expect to learn more about trading analysis in the upcoming videos. This three-part series is designed in such a way to provide complete understanding of long-term investment for wealth creation. Make sure to check the first two videos in the links provided here. See you soon. Until then.